Hello and good afternoon. Yes, school days, dear old golden rule days, as they say. It is that time of year. My daughter's first day was today. She started her junior year in high school. All I can say is, wow, it's super crazy. I can't believe it. It's just, it's amazing how time flies. But I want to thank you all for tuning in today and spending some time with me on this start of the unofficial end of summer. I focus in on the unofficial because you know how I feel. But you are listening to The Financial Chick Show, and I am the Financial Chick. My name is Denise, the CEO and owner of Diversified Financial Solutions, a full-service independent financial planning firm located in Medford. Your Financial Chick is here to help you make better financial decisions and choices to help improve your life and reduce your anxiety and stress about money. If you want to know more about me or my firm, you can check out my website at financialchickshow.com. Also, if you missed a show, you can always click the media tab on the website and listen to any past show. We are also on Facebook and Instagram at Diversified Financial Solutions. We always have some stuff posted every week, so check it out to see what's happening and get some really good updates. So, on the whole school theme, I guess you have to thank Uncle Joe Biden for canceling $3.9 billion of student loans, or maybe not. Sounds like a valiant plan, but it came with much shock and dismay to many. So what is going to transpire in this this student loan repayment or cancellation? So basically, if you have a federal loan and you earn less than $125,000 annually or $250,000 for a household, you will get up to $10,000 in debt cancellation. If you also received a Pell Grant during your education, you could qualify for up to $20,000. The only caveat is if you had a private loan from a bank or whatever the case may be, you are not eligible for forgiveness. So this is just the federal loans and Pell. But a few interesting things to note. One, if your loans are in default, you actually still can likely get forgiveness for those. If you never finished your degree or are still in school, you can still qualify as long as your loans were dispersed by June 30th of this year, 2022. So you may not have to apply for forgiveness if the Department of Education has your income data. So if that's in the system, this may come right through without anything to do on your part. But if not, you're going to have to submit income information via a simple application online that's going to be available in early October. So, it's kind of interesting. Let's see, what else can I let you know about this exciting thing? One thing with the loan balances, so depending on what you have, it's just going to be $10,000 or up to $20,000 with the Pell. But payments are going to resume starting in January of 2023, so that doesn't change. That's you're going to have to start paying back that, and you also may qualify for a newly available income-based repayment plan. So they're going to calculate it based on your income-driven plan. But these are all things that you're going to have to take initiative. So you're going to need to be on the ball and see what's going on. One of the interesting things that's still, we're still tentative, I guess, is really Biden allowed to forgive student loans, and will the forgiveness really happen? So this is a big question about the legality of Biden canceling federal student loans. So the plan is expected, of course, to face legal challenges in the coming months, but legal experts, they remain divided over whether or not it will be struck down by the court. So again, keep tuned. If we hear anything on our side, I will certainly bring it to you on the air and let you know if there's been any changes or any updates. Another big question that I've heard is, do we have to pay tax on the forgiven amount? And apparently there isn't tax on the federal level. There was a provision in the 2021 American Rescue Plan. However, in many states, you may be required to pay income tax on that canceled student loan debt, and one of which is right here in the good old state of New York. There are 12 others other than New York that also have it, including Pennsylvania, South Carolina, etc. Now, what's very interesting, this is how when government takes charge of anything, apparently nobody's going to receive a tax form for the forgiveness, again, because typically on the federal level, it is not going to be taxable. So the IRS would typically put together a Form 1099-C of cancellation of debt, but they're not going to do that. So it's going to be interesting to see how those 13 states handle that with regard to taxing. So I guess it's the honor system. I don't know. We shall see. So there's a lot of questions that are still out there. People are not happy because it really doesn't solve any problems. And really what it does, it further divides people. I mean, it's literally the top 1% of the population, or the 1% of the population that this is going to affect. And, I know that they don't like 1%, like the top 1%, it's just kind of interesting. Now, of course, it divides people also in another way, those that are responsible, that paid their loans or are paying their loans, and those that willingly took those loans but feel that they should not have to pay them. So what is next? Not to mention, it really is a Band-Aid, and I really don't feel that it's a fix. Certainly the people that are receiving the $10,000 probably will feel much differently. But when you look at it from a different standpoint, the government could have did a lot of other things to help everybody over all these years. Rates on the student loans remained at 4% or better. I've seen 4 to 8%, with clients showing me their loan statements. Now, when the federal fund rates went down to a low of 0.25, they still continue to charge students, you guys, anywhere between 4 to 8 or whatever your rate is throughout all of those times. Now, who was making those federal loans? That would be the federal government. So who is benefiting from those loans? I think you know the answer. And they constantly talk about wanting the rich to give up their money to others. So maybe forcing colleges to reduce their tuition so students can go to college and not have to take out such big loans and not be so far in debt when they graduate might be a really good alternative. We don't hear anything about that. So again, it seems like a wonderful and valiant and great plan, but it screams that they're trying to buy votes for the midterm election. There's just so many other ways this could have been sliced and diced, and I don't know. It just doesn't sound too beneficial. It's just ripping off a Band-Aid, but not helping the actual problem. And one of the things, I was talking to the executive producer, and it's true. Biden went in and spoke to when gas was so much, he wanted all those gas stations to reduce their prices. But I don't see him yelling at all the colleges, you better reduce your prices so our students, our American students or foreign students can actually afford college without having to take a lot of loans. So again, sounds a little bit strange to me. I'd love to know what you think. But anyway, I know a lot of you out there are listening. A lot of you that are listening to me today are responsible and want to take control of their life without depending on the government. You are my people. So today I'm going to talk all about 529 plans. Whether you have one or looking to start one, you're going to get all the important information about the 529. I know there's so many questions. I mean, people have heard of it, but they don't really know exactly what it is or how it works or how to take money out. And the questions come into my office all the time, and it's very pertinent right now. Well, most of our college students are already in college, although a few of them, it's all over the place. A few of them are starting soon, but it's really all about school today. So what is a 529? Let's begin with the basics. So most 529s are similar to 401k plans or variable annuities. So a lot of people kind of have a little bit more familiarity with that, in the fact that they offer a menu of investment choices. So the 529, I always say, consider it like a pot of stew, right? You have a pot of stew, and what's in that stew? Well, you could put in steak, you could put in chicken, you could put in carrots, you could put in potatoes, whatever it is. So the 529 is like that pot, right? So what you put into the 529 will be predicated on the plan that you have. So typically investment options consist of portfolios similar to mutual funds. You could have exchange-traded funds. But in addition to that, you have individual portfolios, which are age-based, meaning that if your child is like a year old, it could be, a target for 17 years away from intended, the intended goal. And there's also risk-based. So you could come in and say, wow, I'm a super conservative person or super aggressive, and you could put a risk-based. So it would be based on your risk tolerance as opposed to time. So I'm going to kind of wet your whistle there, but we're running into the commercial break, so I just want to let you know you are listening to the Financial Chick Show. I am Denise Nostrom, and the company is Diversified Financial Solutions. I help you look for financial solutions when you feel like there are none. Feel free to contact me at 631-758-8691 or at financialchickshow.com. So we're going to jump into the commercial break, but we're going to come back and we're going to talk all about 529s, questions that you have, how does this thing work? So stay tuned after the break.
Minute 30.
Okay, thank you. A lot of information here.
60 seconds.
Okay, thank you. Just trying to wean it down a little. Time goes fast.
Seconds.
Okay, thank you. Welcome back. This is Denise Snowstrom, the Financial Chick. The company is in Medford, and you can reach me at 631-758-8691 or visit my website at financialchickshow.com. I'm here to help you on your financial journey. Over the years, things change, and I'm here to help you navigate all those changes. So today we are talking about 529 plans, taking the mystery out of what the heck is a 529 plan. So before the break, talking a little bit about it, that 529 is not very different from, your 401k at work or a variable annuity that you may have, with regard to the fact that it's a plan. Now, of course, it's geared toward college education as opposed to the other plans I just talked about. But in terms of investing, you're not putting it into a money market for the most part. You're not putting it into the bank. It's an investment. And the investment options usually consist of mutual funds, exchange traded funds. You could have individual portfolios, age-based, or risk asset-based portfolios. So it really depends on what it is that you're looking for. I mean, many of my clients, we sit down, we have a discussion, we talk about it, and we look to see what would best serve them. And of course, it depends on what they're saving for, what type of college. Is it Harvard? Is it Suffolk? And also what the time frame. Is your child 1 or is your child 15? So that all those things come into play. So in New York State, there's really 2 plans. I mean, you can have any plan, but the actual New York State plans, there's a direct plan, which is managed by Vanguard, and then there's a advisor guided plan, which is managed by JP Morgan. And typically, I use the advisor guided plan. The direct plan is for those people that are self-help, want to do their own thing. Of course, it is a little bit cheaper than the advisor guided plan, but the advisor guided plan, you get me. And with that, as I go through all of the different ramifications of a 529, typically it's good to have somebody to talk to, because there's a lot of stuff going on that you may not get in a self-help unless you do a lot of the research yourself. So it's really whether self-help or you need some guidance. So what are the facets of the 529? Well, one is the owner or participant. And in most cases, that would be an adult. That would be the person that owns the actual plan. Then secondarily is the beneficiary. The beneficiary it's got to be an individual, and in most cases it would be the child. But there is no age limit on who can be named a beneficiary, so I'll talk a little bit more about that in a second. And then the last piece of the puzzle is a contributor. And in many cases, a contributor is also the owner or the participant, which in many cases is the parent. But it's not a requirement, that this can be opened up by aunts, uncles, grandparents. So the 3 things: the owner, the beneficiary, the person that you're saving for college, and then the contributor, which again could be the owner or somebody else. So basically, you don't have to be related. Like I said, if you have an aunt and uncle, it could be a relation, or you could open up for a friend. Maybe you have a very close friend that you have a child that you want to help out. So as far as funding the plan, there's no age or income restrictions. So this plan really can stay in perpetuity. You can establish the plan, and it has no time limits or age limits. On the federal level, contributions are made on an after-tax basis. So all that really means is that you're taking money from your savings account or from income that you earn and putting it into this, and the earnings grow tax deferred. So you don't pay taxes on this every year. You're not going to get a tax form that you have to show to your accountant each and every year. Withdrawals are another situation. They are tax-free when they're used for qualified higher education expenses. If you take it for other reasons, we'll talk about how that is not such a good idea, but it's possible. So there's no annual contribution limit. You're not limited to a certain amount that you have to put in, or minimized to a certain amount that you can. There's no maximum and there's no minimum really. But there is a maximum in terms of what the plan can hold. The plan in New York, actually, when it gets to $529,000, which could take you a little while, then you cannot add any more contributions. So you got a little bit of room to run there. It also can be used for estate planning purposes. If there's grandparents or even parents that want to get money out of their name, this is something that you can put money into the plan, and you can push the funds to the maximum. So you can put $16,000 a year, which is a gift. And if you decide that you want to do it all, for like a 5-year situation, you could put up to $80,000 in 1 year. But the caveat on the other side is that you wouldn't be able to add any other contributions after that 5th year. So again, this is a little bit of a detailed thing, but if you have some estate planning issues, give the office a call and we can help you, look at some of those things. So there's no federal deduction, but the interesting part about the New York plan, there is a state deduction. So it's a credit on the on your state tax return. So if it's $5,000 or up to $5,000 contribution for singles, up to $10,000 for a married couple. So let's just use an example. A married couple with an annual income of $100,000, putting away $6,000 for their child, they would save $358 on their state taxes. So it doesn't sound like a great deal, but if you pay state taxes normally and you're not putting money away for your child for college, this could kill two birds with one stone. Obviously, it becomes a better situation when you get closer to having to pay the tuition bill by having some money to do so. But as you're saving each year, you can have some state tax deductions too. So that's pretty cool. So the big thing is withdrawing the money. Now you've built up this money all these years, and now your child is ready to go to college. How do you get that money out, or what can you use it for? Well, it's used for tuition and fees. You can use it for books, supplies, computers, and other equipment. Again, as long as it's used for college. You can't buy a computer and then give it to your mother-in-law. You have to actually the computer has to be for use of the student. Room and board if you are attending school more than half time, so you have to be a full-time student. And then expenses for special needs or services incurred in connection with enrollment or attendance by special needs beneficiaries. Tax reporting is pretty simple. I mean, if you are using this money for college, let's say the tuition bill, and I get this from clients all the time, they go, okay, it's that time, usually around July, end of July, August, my, just give you a number, $8,254.60 I have to pay the tuition bill. We actually push that money out and show that it's a qualified withdrawal. And I just tell them it's a good rule of thumb to put into their file cabinet just the bill, and then the amount that they put in case they ever got audited to show that it was indeed used for college. And that's it. I mean, that's pretty simple. And the good thing with the 529 is that now, not just for college, it can be used for primary and secondary education, meaning that you can use it for kindergarten to 12 private school tuition, up to $10,000 per year, which is a pretty big thing. And you can also use it to pay down student loan. So if you take a student loan to create, which I encourage people to do, especially the student, to get some, and not a lot of loan, but to build up their credit, it's a good thing. And then knowing that down the line they can use that 529 to pay it off. Now, if you do non-qualified withdrawals, meaning you use it, let's say, to buy a car, that would be taxable. So let's say you took out $10,000 as a number, and you would have to show $10,000 of income on your taxes, plus any penalty on the earnings. So let's just say you put in $6,000 and it grew to $10,000, so you have $4,000 of earnings. You'd have to pay 10% of $400 on that. So you probably don't want to do that. Some common questions: distributions from 529s can be made to the account owner, the beneficiary, the school, or for rollovers, but they must be coded correctly. So that's important. This is what I'm saying. The self-help is great, but there's so many different moving parts on the plan that you may want to work with somebody that knows all the rules and regulations. Non-parent owned 529s are no longer counted as assets and student income for FAFSA forms. Very big deal. If people are familiar with the financial aid formula, parents' income is 22 to 40 7% of available income, whereby students it's 50% of adjusted gross income over $6,840. So, if it's better that these 529s are in the parent's name or the grandparent's name, because then you have a better chance of getting some financial aid. So it's really very important how you register and how you own it. And I guess the worst case scenario, let's say you don't use it, because that's one of the big questions too. There are 6 ways that you can use the leftover 529, which I'll go through real quickly. Transfer the 529 to another beneficiary. You have another kid, send it to them. Save the 529 for your child's future educational needs, because you never know. Use the money to make student loan payments, which I already mentioned. Save the 529 for grandchildren. There's no time frame, so you can really roll this over and not pay tax on this fund. Take advantage of penalty-free scholarship withdrawals. And finally, use the 529 for non-qualified expenses, even though you know it's going to be taxable and you may get some penalties. But you know what? It's your money, and times change, things happen, so you just never know. Know that there's options. Call me with questions. You're listening to the Financial Chick Show. You can reach me at financialchickshow.com if you have any questions, thoughts, ideas about what we talked about on the show. But I want to thank you for tuning in. Remember to let's do better and be better, and have a wonderful Labor Day weekend, and I will see you next Friday. And that is a wrap. So that was everything you wanted to know or not wanted to know about 529 plans. It's a pretty good vehicle, actually, to save, because not all of us get money from the government. Well, listen, have a wonderful, wonderful Labor Day weekend. I can't believe it's here, but enjoy time with your family and friends, and we'll see you next Friday.